Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, there is a major war going on, and it's not the one in the Middle East. It's the one that's going to affect your pocketbook. It came to a head this week. We're going to talk about all the data that came in and what it means for you. Let's dive in.
Trade Genius.
Okay, Bob. So, we just finished an extremely heavy economic data week. A lot of stuff came in. The market climbed the wall of worry, which we warned about because we were super oversold. But it's like it's basically done a 1 month move in 1 week. So we've got that. We may cool off next week. But I think the bigger thing was, and it's the one thing that's not really well known or maybe even misunderstood or maybe not even known at all by most people, is the quarterly refunding announcement by Yellen. And what she did declared war on the Fed. Can you take us through it?
Yeah, and I'll let you walk through the quarterly refunding, but they always say this phrase, don't fight the Fed. Well, Janet Yellen has made it her mission to fight the Fed, maybe because she used to be a Fed chair, maybe because she's an MMTer, maybe because she's a leftist, and leftists hate anybody else controlling their spending and the cost of their spending. Is that she has been at odds with Jerome Powell since March of last year. And she's pulled another rabbit out of the hat here to try to, keep the Bidenomics train from actually going off the rails. But we're going to talk about that in a second. First thing I want to actually show you, Phil, is let's do the 10-year one first, because this was the one that we reacted to in the room that'll affect the other elements of the stock market. So the 10-year yield came down really hard on the news with Fed pause and with the unemployment rate being weaker than everybody expected, and also all the constant revisions backwards in time. But it came down and hit its head on an upwardly sloping trend line, and it bounced off of that. And one thing that I always like to look at is that what's happening in that last half hour of the day, and then also on Friday. And the market said, I think we pushed the 10-year down enough. Janet Yellen had, one of her games she played was she kept funding out of the picture for, I think it was 12 days, basically creating an environment where there was a demand for bonds versus a supply for bonds. And then also, one thing I'm going to just shut up for a second. I'd like you to explain what she did with the 10-year in terms of driving that price down, and then we could talk about the Wyckoff chart.
Yeah, in a nutshell, what she did was she laid off the long end of the bond spectrum, right? The expectation was there was going to be more coupons being issued, which is what sucks liquidity out of the market. And she actually let her foot off the gas in terms of that. And she went more to T-bills. In fact, the percentage of T-bills this round is quite heavy. And so what that's going to do is juice the market. So it's a form of quantitative easing actually that she's doing that the Fed absolutely doesn't want to see. The Fed's wants to keep rolling off their balance sheet, which they're doing, and they're staying steady on that schedule. They haven't really deviated. So they're doing what they're saying there. But what they really want are tighter financial conditions to win this war on inflation, because it's kind of one of those things. If you gain momentum on getting inflation down, you have to kind of keep at it, because it's like a beach ball in the water. It's going to want to keep coming back up if that beach ball got too inflated, which it did. So they're very keen on getting the financial conditions tighter. That means higher interest rates for borrowing and trying to slow down the economic expansion to get that back down. Once inflation is down and down for the count and sideways for a while, then I think you'll see a little more in terms of, them being softer on that stuff, and rates can come back up, or come back down, I should say. But right now the fight is to keep those rates on the higher end. So what Yellen did, and you can see it with this TYX chart, is effectively erase 2 rate cuts for the Fed. Now, will the market bounce back and buy bonds, sell bonds, and then the yields will drive up? We'll have to see how next week goes. But this was a knee-jerk reaction to Yellen basically saying, look, I hear you in the bond market. The long end's getting beat up, the 30 years getting beat up, the 10 years getting beat up, which you see in TLT. So I'm not going to issue as much in terms of that, which is, you can say that because, okay, that might be reasonable, but in the long term, it's unsustainable. It's kicking the can down the road, because you cannot have this level of T-bill issuance realistically and be able to pay it back, right? It's too short term. It's a cash flow problem.
Yeah, sorry to interrupt you. She's doing exactly what the banks did, and she committed a fatal error 2 years ago when interest rates were at zero. Why wasn't she locking in 30-year bond yields at 2.5% or wherever it was versus now at 8%? mean, this woman she's clueless or she's trying to blow the system up. So it's one or the other. And now she's doing the same thing on the short end. She's creating an environment just like how the banks had to be rescued by going way short on when bond yields are low. And now any kind of mistake in inflation starts popping these things, or the Fed decides, you know what, we're not buying any of your T-bills. Then what happens? Then all of a sudden she's paying, 6%, 7% on 90-day money. And then that literally blows up the banks, Phil. Literally blows them up. So she's playing the game of chicken with Powell and is saying, hey, he has to protect the banks. So therefore, I have a hall pass to do what I want to do. And I heard a rumor on Friday is that he's going to stick to his guns. And if they don't like it, they could fire him. So it's going to be really interesting to see, how this plays out. But that's just one end of the problem, Phil. The other one is check out this Wickoff chart on, I think this is the NASDAQ one, right?
Looks like this is the Roundhill Big Tech ETF, BIGT.
Yeah. So look at this. This is a classic, basically what I would call the wide Eiffel Tower, right? So, these three moves that stayed in the range, we broke the range, we're going to make a lower high. And I think when this thing rolls over, this is the one that causes the cascade. And you can see it in tech. I mean, look at Apple, look at Google, right. Look at Meta. Their growth rates are collapsing. And these are the Mag 7s. And the only reason why they have such high PE ratios, other than the manipulation of it being market cap weighted, is that they were sure bets. Right. They're going to grow, they're going to dominate, they're going to continue to generate cash, but that's no longer happening. And, as they roll down, the market will have no choice to follow. Even if the equal weighted indexes hold up, the whole market's going to go down because the Mag 7 dominates. Right. And I think we're going to get the worst of both worlds here, Phil. I think Yellen, everybody's looking for the Santa rally. Yellen may have just dragged it into October with her absolute need to control, the bond market. The unemployment reports are telling us jobs are going away. We talked about this yesterday. And that's not changing. Once the job market starts to do this and sales start to soften, companies are going to just keep letting people go in order for them to survive or try to keep margins so their stock prices don't collapse. Right. So I'm going to throw this back to you, Phil. I think you have something else you want to show.
Yeah. What I wanted to do was take a look at the yield curve. So the yield curve, to me, this is like what is going to determine the recession or not, because when you the yield curve crosses up over this white line, basically, that's your zero line. That's when I'm comfortable in saying, okay, we've got recession now. Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. We haven't done it yet. And what Yellen has done is actually helped keep this down and stay inverted. And so I'm not comfortable saying, yeah, we got recession until I see this cross up. So we have a little bit of a battle here, right? I was thinking recession possibly at the end of Q4. I think that's been delayed because of what she did. And we're going to need to see what the reaction is going to be from the Fed. If the Fed raises in December, because I think that's back on the table, Bob. Nobody's talking about that. It's not priced in the Fed funds futures, but let's see what happens this week. We have full slate of Fed speakers. I think there's like 4 a day for every single day of the week. It's really full. One of the fullest speaking schedules I've seen from Fed governors in a long time. Let's see what they jawbone about this week. If I suspect they're going to start talking about the possibility of another rate hike in December. And then if we do hear that, we're going to see the Fed funds futures climb up and reprice in the probabilities of a rate hike. And if that's the case, then, that's going to help this yield curve climb back up. So we're kind of in a wait and see here. But my initial reaction based on what happened this week and about 50 basis points of interest rates taken, or the yield dropping by 50 basis points, I think you have to realistically say, well, maybe the recession is going to be pushed off another quarter. So that's until we get through this week, that's kind of my take on this. I'm not as aggressive on that recession in the timeline that we were thinking before. So does that give the markets a little bit of a reprieve? It can. I think you got to pull back a little bit from this move, but I think we could, you were saying Santa rally, and I would say that the odds of that are much better now, given that the financial conditions have loosened loosen. So, we're still tracking though. We're still tracking to the yield curve normalizing, going positive. This upper green overlay is kind of the historical track for when we get a yield curve, a bottom in the yield curve, and it starts to normalize. We've actually been ahead of that in terms of normalization. We've been tracking pretty well below here on what you would expect the stock market to do. Now we're deviating a little bit because of that pop there that we got, but overall we'll have to see how this plays out. And really what I'm curious is how Q1 plays out, because that's usually where you're going to get a lot of weakness, and then you're going to see this normalize. So maybe we'll get our official, like how we measure it, or at least I measure it. Maybe that happens in Q1. The data is still going to have to come in week 2. We're going to have to continue to see job data deteriorate. So it's interesting because we're in the middle of a heavyweight bout, and we're in the 5th round of a 10-round fight, and they're exchanging blows. So we still haven't figured out who's going to win yet.
Yeah, well, look, they took the VIX from almost 22 down to 15. So they basically spent that money already too on the VIX to just drive this short squeeze downfill. And the other thing people aren't realizing is that most portfolios are red for the year. And so you're going to get tax loss selling in November as well, so people can lock in their cap losses for the year. We only have 30% of the stock market still above the 200-day moving average. And it was the most shorted names that got popped this week. So it was a garbage move. What I mean by garbage move, the garbage performing stocks had the best returns. And that's not what a bull market, everybody's talking about the breadth thrust and, the momentum thrust that we had this week. My view is probably a false dawn because, if yields keep rising, more and more risk managers are going to be opting into when people say their portfolio, hey, I can get 5% on short money, or I could be down 6% for the year with volatility. Let's start opting towards more safety. And so I think it's one of those things where I think Janet Yellen, she's shooting at the marauding invaders a little too early, and she's going to run out of ammo before they get to the walls. And I think it's going to blow up for Bidenomics come November.
I think that what we have to look at now going forward, because it can get complicated, right? About if you start thinking about all the dynamics in play here. I think the simplest thing we can do is look at the 30-year. Is the 30-year over 5% or not? Right now it's not. It dropped tremendously this week. But if it starts creeping back over 5%, then I think you have to look at the stock market through a bearish lens and keep it as simple as that. That's your bullish or bearish line in the sand, if you will, and let the market dynamics play out, and the result of which you'll see in that chart, the 30-year. And I think you can keep it simple like that.
Yeah, and I think, and more tactically, Phil, I think, and we were going to title this a different title, and we're going to title it. But, one thing, too, all it really matters now is the funding. So everybody needs to get really familiar with what funding is going to happen and what issuances are going to happen in each individual week, because the longer the duration, the more pressure on the market. The shorter the duration, the more accommodating the market's going to be,
right?
Because of collateral and flows.
Right.
And so I think that's really what you have to pay attention to. It is obvious that fundamentals don't matter at this point, and technicals really only matter at the edges.
Correct.
We had last Friday, a week ago, we said, hey, this market is due for a bounce, not because we're freaking geniuses. It's just that it was so extreme that algos are going to push it up. And once that fire was lit, it just took off like a firecracker. That's what really you have to look at now. Funding first, level second, fundamentals third, and seasonality obviously is going to be important here for the next 3 months as well.
Yeah, so the next funding announcement is at the end of January. So that'll be dictating the next knee-jerk reaction in the market. That's going to be looking ahead at Q2. So this last one that we got a couple of days ago, earlier in the week, that was for Q1. And a large driver, I believe, of why we had this knee-jerk reaction. And then it was just compounded by just how over or mispositioned everyone was. You guys saw the CTA charts and things like that. It was way oversold. And breadth was too oversold. We were going over those charts in the room. So the bounce isn't surprising, but the severity of the bounce is a little surprising. It's just this market's got so much derivative leverage in it, I think, is part of the problem. And everything's just amplified now. And I agree with you on the breadth thrust stuff, is that those are based on a market that we don't live in anymore. The moves are much more dramatic now, and it's all driven by leverage. So, there's some stuff that, yes, does still matter, but I think we're getting to a point now where we have to measure this market in different terms because of the unwinding of leverage, and because leverage and derivatives are basically now what control the market versus what, fundamental flows and things like that. And so I think it's a different market in terms of kind of those historical measures. So we'll see. I mean, breadth thrust isn't a joke, but I just don't know in this context checks if it means, because usually they mean that means kicking off a longer bull run. And if the jobs data is going to continue to deteriorate, and that's the other thing too, is if you take those things in context of where unemployment is on the rise, right? And typically those breadth thrusts come from a place where unemployment has already risen to a point and then leveled off. Unemployment from, economic downturn, then you get those breadth thrusts out of that. So we're not in the same spot that we usually get those in there. So there's a bit of a caveat there. And I think this looks a lot like what we saw in 2022 in the first half, where we had these violent face rippers. So if we're right about that, and this is going to roll over, I suspect you're either going to see it on Monday, Tuesday, or Wednesday. You're going to see a drop. Either Monday's the drops right away, we gap back down, or there's a consolidation on Monday, maybe through Tuesday, and then Wednesday you see a drop, something like that. If we continue to push, then you don't want to fight it. I mean, you can't fight it, because then you're kind of looking at a situation that we were in when we were driving up that last part to top of July. It was overbought and it stayed overbought, right? So that's the part we don't know. And I think all you got to do is just let price show you the way. That's just the result of what's going on under the hood, and you don't have to get it too complicated about it.
Yeah, I totally agree. I remember these restaurants come in pairs, and so a lot of time you make a lower low on breadth before you get a low. So it's going to be really interesting. And with that, guys, enjoy the rest of your weekend. Hit like, hit subscribe. Thanks for those who have subscribed to the channel and also to our service. And notification, tell your friends, and let us know what you want us to talk about. We pick the things that we think is important, but you're our listeners, so you tell us what you would like to talk about. And Phil uncovered something pretty interesting in crypto. Maybe we'll talk about it next week that I think might be an advantage, and it's really an unusual one. So stay tuned for that. We'll try to get to it next week. Thanks, Phil.
Trade Genius.